FXN show, what's up guys? Welcome back to the channel. Welcome back to another video. As we continue our free trading course here on YouTube, we want to welcome you back to Trading with Market Makers 2024 week 11. Now, if you haven't watched any of the previous weeks, or if you're new to the channel, hi, my name is Mark. I've been trading since 2011, and I'm just here sharing my strategy with you. Hopefully you can get something from my strategy and hopefully to help you in your own trading. If you are new to the series, do me a favor, go back to the beginning so you can catch up on the series. You can do that simply by going to the playlist and clicking on the FXN Mentoring 2024 playlist and start from week 1. So with that being said, guys, let's get right into it. Last week, we talked about risk management. I hope you got a lot of value from that particular video. And so, of course, we now continue on to week 11, where we're going to talk about trading plans. So two things that do not get talked a lot about at all are risk management, how to do it. I showed you that last week. And then trading plans, most importantly. How are you going to plan out your trades? How are you going to be consistent, successful in trading, which is probably one of the most difficult careers you can think about doing? How are you going to do that if you don't have a plan in place? So another video that, again, not a lot of people talk about, not a lot of people worry about, but these two videos, week 10 and week 11, are probably the most important videos, because this will outline for you how you can be consistent and actually draw out a plan for you. So let's get right into it with creating a trading plan. So when developing a trading plan, there are several essential principles to keep in mind. The first thing is the purpose of a trading plan. The core purpose of a trading plan is to keep you focused and consistent in your approach. A well-structured plan eliminates guesswork, guiding your actions and ensuring that you execute your strategy with precision every time you enter the market. This is very important, guys. Whenever you're talking about the purpose of a trading plan, if you're not understanding why you need to have a trading plan to begin with, then you probably should not be trading. You probably chose the wrong career. Having a trading plan in place basically is going to allow you to take trading and make it very black and white, because you're either going to have the setup that meets all of your plan or it doesn't. And if it does, you take the trade, and if it doesn't, you don't take the trade. The purpose of a trading plan, I think, for me, it makes my trading very simple and very black and white. It's either a yes or a no. It's not a maybe. It's not a wait to see this or wait to see that. The trading plan, it is what it is. And I know that if I follow the plan, because I've back tested the plan, so if I just follow the plan, I know over an extended period of time, I know what it'll spit out for me. And so as long as you keep following the plan, you'll be consistent. Personalization. Your trading plan should be uniquely tailored to you. Every trader has their own style, strengths, and preferences. So it's vital that your plan reflects your individual identity as a trader. A personalized plan helps you stay aligned with your natural trading instincts, building confidence and consistency in your approach. You have to remember that every trader is unique and different in what they like and what they don't like. Their own style, their own strengths, their own weaknesses. So the cool thing about the strategy that I use is that there's so many different things that you can trade that you just have to be really good at one. And you can just use that one strategy and be good. You could be really good at type 3s. You could be really bad at type 2s or type 4s or whatever the case may be when it comes to the strategy that we're talking about here. But the important thing is that you can take your own identity from what you're learning and put it into your own trading plan and create a trading plan around all of your strengths, all of the setups that you like to trade, all of the confirmations that you like to see. These are all very important factors, but they're also very individual factors for you specifically as a trader. So it's important to make sure that your trading plan is personalized to you specifically in how you trade. Third is simplicity and clarity. A trading plan should be straightforward and easy to follow. Complexity can lead to confusion and errors, especially in a fast-paced market conditions. Your plan should be clear and concise, allowing you to implement it seamlessly in any trading scenario. So there's nothing more important to a trader and your trading plan as simplicity, because simplicity gives you clarity. And without these two guys, you're going to be very, very confused, and you're going to be making a lot of errors in your trading. So simplicity and clarity, huge factors when creating your trading plan. Rules-based framework. A strong trading plan is built on a solid foundation of clear rules-based guidelines. These rules enforce discipline and consistency, helping you approach the markets with a structured mindset. By adhering to a rules-based system, you can reduce emotional decision making and maintain a disciplined trading process. This right here, rules-based framework, is probably one of the biggest things that helped me become a consistent and profitable trader over time. Because whenever you have a rules-based system, you make your trading emotionless. Basically, you take out the emotions from making trading decisions. So whenever you're trading, if your trading plan is very black and white and everything has to be, met based on your rules, and you take the trade, it removes all of the emotions that you're going to get when you make mistakes. Because based off your trading plan, if everything meets your requirements for a trade setup and you take said trade setup and you lose the trade, it's okay, because you followed everything that you had in your plan. So there was nothing mistake-wise that you made by simply following your plan. You just lost a trade, and that's fine. No big deal. It's going to happen. The problem is that when you don't have a rules-based framework around the trading plan that you create, and you start making trading decisions and you're not following that rules-based plan that you've created, when you have the losses, you literally start to question everything that you did wrong in the actual trading setup, or you start to question all of your trading decisions leading up to you taking that trade. So having that rules-based framework is hugely important, because it's really the main part that reduces the emotional decision making out of your trading. Now, of course, by focusing on these key principles, you can create a trading plan that not only keeps you on track, but also enhances your performance, ultimately leading to a greater success in the markets. So now let's talk about framework for creating a trading plan. Creating a trading plan is essential for achieving consistent success in the markets. So here's a step-by-step framework to help you develop a personalized and effective trading plan. The first thing is you have to define your goals. You can go ahead and start with short-term goals. What do you aim to achieve in the next, let's say, 3 to 6 months? What are those goals that you're trying to achieve, that you're trying to get out of the next 3 to 6 months? This could include specific learning of different strategies, gaining confidence in execution, or achieving a certain percentage of returns. What are your long-term goals? What are your broader objectives, let's say in the next 1 to 5 years? Consider your financial targets, trading career aspirations, and personal growth as a trader. What is it that you're trying to get out of this in the next 1 to 5 years long-term? Where do you see yourself? Do you see yourself maybe switching over to, once you learn and get a good base behind your belt, do you see yourself switching over to, let's say, options or futures, or trading more commodities or indexes instead of Forex? I mean, there's a lot of different things that you can trade as long as you know how to trade and have the skill. 2, you can determine your trading style. Identify your trading style. Are you a day trader, swing trader perhaps, or position trader? Determine the style that best fits your personality, schedule, and risk tolerance. These are all very important. You have to find what style best fits all three, guys. Your personality, your work schedule, because everyone has a different schedule obviously, and then your risk tolerance. choose your markets, decide which markets you will focus on and the specific instruments you will trade within those markets. So obviously we're talking either Forex, stocks, commodities, ETFs, indexes. There's a host of markets that you can trade, and obviously within those markets there's going to be specific instruments. So in Forex there's 28, 30 pairs that you can pick out of. Stocks, obviously there's a bunch of stocks, commodities, same thing. So I think the important thing that you have to remember about choosing whatever market or whatever pair you're going to trade is that everything should be based off of your back testing and whether or not you were successful at those specific pairs during your back testing. So what I mean is, like, if you take the strategy, create a plan, and you start back testing it, and let's say you back tested it on pound JPY, you back tested it on Euro USD, you back tested on pound AUD, and you could see that from the data that you've gathered that, like, literally you suck at, let's say, pound AUD. Well, guess what? There's no shocker to this that you shouldn't be trading pound AUD. However, if you did really well on Euro USD and pound JPY, now those could actually be the ones that you're actually trading. But very important to understand that whatever pair, whatever commodity you choose should be based on the actual results that you see from your back testing. There is no reason to put money at risk in trading an asset, commodity, stock, whatever you want to trade when your back testing tells you that you absolutely suck at it. There's no point in doing that. All right. Obviously, you want to trade the best pair that fits your back testing the best and that you've back tested the most and gotten the best results out of. It doesn't make any sense for you to gamble out here in commodities just because your favorite YouTuber is trading commodities. So number 3, set clear rules for trade entries and exits. Obviously, entry criteria define the specific conditions that must be met before you enter a trade. This could include technical indicators, chart patterns, price action signals, or a combination of these factors. So obviously, you're going to have your criteria. Everyone has different criteria for your entry for whatever pattern you're trading. So the important thing is, guys, that to make sure that whatever it is that you're picking, you could have, 4 entry criteria for a type 1. Some other trader could have 6. So because everyone's different, obviously some want more confirmations than others. That's perfectly fine. I think the important thing is to make sure that everything that you see or that you have as your entry criteria, it is something that happens over and over and over again, repeatable in your entries for whatever pattern you're trading. Exit criteria, obviously establish clear rules for when to exit a trade. This includes setting up stop losses to protect, obviously against excessive losses, or identifying take profit levels to lock in gains. So again, like we talked about in previous videos, the EMA video, we can use EMAs for take profits and things of that nature. So these are all great things to have in your particular trading plan, and it's very important to set the rules clear. Develop a risk management strategy. We just literally talked about that last week. Risk per trade. Determine the maximum percentage of your capital you are willing to risk on a single trade. We literally talked about that last week. So example, 1 to 2% per trade out of your capital. Position sizing. Define how you will calculate the size of each position based on your risk tolerance and specific trade setup. Position sizing can be very simple. There's a lot of calculators that you can use for free online. Just Google, Forex position sizing calculator, and you'll get a bunch of them. It'll literally ask you for the pair, the entry, and your capital, and how much you want to risk, and it'll spit out for you what lot size you're going to use or you want to use. You can also obviously use, the example that we used last week in our risk management video. That's also dependent, of course, on the capital. Everything is based on the capital that you have. So drawdown management, create a plan for managing losing streaks, including when to reduce position sizes or pause trading for reassessing. We talked about this last week. So if you want to rewatch the week 10 video, it's a good video to watch because it breaks everything down for you. Incorporate key EMAs into your strategy. Obviously, we talked about EMAs. So use EMAs. Define how you will use the key EMAs. So the ones that we talked about, 5, 13, 50, 200, 800 into the strategy. This could include using them as identifying trends, confirming entries, or setting them as take profit targets. We know by the backtesting that EMAs can be used for a plethora of different aspects within our strategy. We talked all about that in our EMA video. Again, if you haven't watched that video, go back and watch that specific video. Confirmations with EMAs, establish how you can use EMAs as dynamic support and resistance levels and confirmation points for your trades. Create a daily and weekly routine. So market analysis, outline your routine for analyzing the markets each day or week. This includes checking key levels, reviewing economic calendars, and identifying potential setups. One of the things that I think a lot of people sleep on is the fact that a lot of people don't even check the calendars, and so they end up getting caught up in a bad trade because they don't realize that there is heavy news for that specific session. So they take a trade thinking everything's good, and then news hits, and then you get taken out on a trade. So very important to make sure you outline this in your market analysis. Trading hours. Define your trading hours based on the best times to trade your chosen markets and your personal availability. Obviously, everybody's personal availability is completely different, so only you can choose those specific hours. It's very important to understand that if you have a job, which is completely fine, you need to trade outside of those hours for your job. So if you're working during the US session, then you're probably very likely going to end up trading the London session. Vice versa, if you're working during the London session, then you're probably going to end up trading the US session based on your availability. Everybody's different, so just please make sure that you define those specific trading hours. Now, develop a post-trade review process. This right here, man, blows my mind. This part is so skipped on. Most people don't even do this, and they wonder why they can't be successful. Trade journaling. Commit to recording each trade in a journal, notating the reasons for entry, the outcome, and any lessons learned. This is so important for you to do on every trade. But I guarantee you, man, like 90% of people trading out here don't do this, and they are missing out on such huge benefits from journaling their trades. If you don't want to write down your trades, like literally like record, like video record yourself trading and then review the video. If you're too lazy to journal, record the video, record yourself trading, and then review the video. Because I mean, the information that's in the journal and in that process at the time, you can never go back and rethink. I'm telling you, this is super important for you to do. Performance review. Regularly review your journal to assess your performance, identifying patterns, and refine your strategy. This right here, this review, is why you trade journal. You cannot make adjustments to your trading if you do not know what you're doing wrong. There's no way to identify what you're doing wrong. There's no way to identify patterns that you're doing in your trading or change or adjust your schedule if you're not journaling. So these two things right here are probably the two most important things to do: journaling and reviewing. Because if you journal, you could see the mistakes that you're making because you're making them over and over and over again in your losses. So please, if anything, if you get anything out of this, trade journal and review the actual trades at the end of the week. The losses. What have you done wrong? Once you have, let's say, 100 losses in a journal, you could literally see a pattern of what you're doing wrong, things that you can adjust. Okay? But you cannot get any of that if you're not journaling. Rules-based discipline. Adhere strictly to the rules you set out in your plan. Avoid making impulsive decisions based on emotions or market noise. This is why you have a trading plan, so you can actually just follow the plan. If you have a trading plan that you've written out, you've back tested the plan gives you over an extended period of time, let's say a year, 2 years that you've back tested of data, and it tells you if you just follow this plan, you'll have X, come out, spit out. If you know that up front, why would you not follow it? Like, why would you not follow it? It blows my mind how many people just stick to a trading plan for literally like a week, and then everything goes out the window once you have 2 or 3 losses. Like, what if I told you that if you take 1,000 trades and you were going to have, let's say, 300 losses, but you would have 700 wins? What if I told you that you're going to have 300 losses at the very beginning? What would you do then? Would you still follow the plan if you knew that 300 were going to be hit right away, and then you knew after that 700 would be like on every single time? Of course you would. You would follow the plan. What's the freaking point of having the plan? Emotional management. Develop techniques for managing emotions such as meditation, mindfulness, or taking breaks during high stress periods. Stay adaptive and continuously learn. Obviously, strategy refinement is very important. Be open to refining your strategy as you gain experience and market conditions change. Guys, you can go back to videos that I made back in 2019. The strategy that I showed back then in 2019 is not the same strategy that I use now for myself. There's been a lot of refining, a lot of changes that I've made over the last 5, 6, 7 years to my own strategy and to the trading that I do. And that's solely based on gaining experience, but most importantly, the journaling and the back testing and the data that I've collected over the years. Ongoing education. Obviously, commit to continuous learning through books, courses, and engagement through a trading community. All this is very important. You don't want to just stop learning. All right, always continue learning. Always continue ways of changing or doing little tweaks to the strategy, making it better for you. Maybe taking out one or two things that you noticed that over time really didn't make a big difference. Okay, so there's a lot of things that you can do to make changes and continue the learning process throughout your trading career. All right, so what I'm going to do now is we're going to head over to the whiteboard, and I'm just going to share with you a very simple, trading plan that anybody can make, and you can just see literally how simple you can make it if you really wanted to. All right, so let's head over to the whiteboard. All right, so now that we're on the whiteboard, let's talk about creating a trading plan. So here's a couple things that I want you guys to keep in mind when you're creating a trading plan. What has been some of the things that you found to be very successful to you? So meaning, think about the patterns themselves, type 1s, 2s, 3s, 4s. Out of all those examples that you guys did for homework, what patterns come to mind that have been the easiest for you to follow, to see, to trade? What are those specific patterns? And the reason I want you guys to focus in on that is because when you can focus in on a specific pattern that you're really good at, you can start to see them on the chart a whole lot better, and you'll start to trade with confidence. Okay? Now, if you see yourself being able to trade all 3 patterns or all 4 patterns, that's fantastic. That's great. Awesome. Okay. But what I'm going to show you is how I would create a trading plan if I wanted to trade my favorite type of setup. So let's say that my favorite type of setup is going to be a type 3, and that really is my favorite setup. So a type 3 setup trading plan. So when you think about that type of a trading plan, what's the first thing that comes to mind when I'm trying to create a trading plan that I want to be rules based, right? So when I think about being rules based, I think about simply putting in certain factors that have to be there in order for me to take a trade setup. Okay, so if I'm looking at a type 3 setup, the first thing for me is directional bias, right? So I must have a directional bias set up first. So I got to have a directional bias. That's the first step. Okay. Once I have a directional bias, I know whether I'm buying or selling. So this could be like, think of it like a checklist, right? It could be as simple as yes, no. So you could have it set up. You could create like a spreadsheet or whatever of this, and just have one directional bias, yes or no. Basically, you're asking yourself, do you have a directional bias, yes or no? If you do, yes, cool. What's the next thing? For me, if I'm looking at trading a type 3, is did price action come from the top or bottom and get stuck in the middle of the range? Yes, no, right? That'd be the second question. So I'm automatically asking myself, did price action come from the top or bottom, right? Because I don't want to trade a type 3 that comes out of the Asian range through the middle, right? We talked about this during the patterns themselves, that on type 3 setups, you want them to come from the top or the bottom and then get stuck in the middle, right? So that's my second question to myself. Did price action come from the top or bottom and get stuck in the middle? Yes or no? If it did, cool. Let's go to the third one. The third one would be, is price action bouncing off the 50 EMA? Yes, no. Is price action bouncing off the 50 EMA? Yes or no? 4. Did price action give me a pattern to trade, or to enter actually, once it was rejected from the middle of the range? Yes, no. And I'm doing these in the form of a question, but you can do it however you want to. So for example, instead of saying, did price action give me a pattern to enter the trade once it got rejected from the middle of the range, you could just simply say, do I have a pattern to trade at the middle of the range? Yes or no, right? And you're basically asking yourself, did the type 3 give me a railroad track, star pattern, quarter wood in the middle of the range that I could trade to enter, right? So another thing is, if I'm trading this, let's say my pair is pound USD, right? So on pound USD, my stop loss is going to be about at max 20 pips, maximum. So the next thing I'd ask myself is the risk to reward ratio, is the RRR, risk to reward ratio, 2 to 1? Yes, no. So I'm just basically asking myself, is my risk to reward ratio going to be 2 to 1, or is it 2 to 1? Can I get a 2 to 1? Next thing I would ask is the TDI bouncing off the 50 line? Yes or no? What am I looking for? I'm looking for a confirmation, right? The 50, is the price action bouncing off the 50 EMA, yes or no? And is the TDI bouncing off the 50 line? Those are confirmations, right? Another thing is the pattern, or not the pattern, the setup. Is the setup happening at the right time or at the correct time? So meaning, is it in the box? That's what I should say actually. Is the setup happening inside the London or New York box? Yes or no? Right? That's going to be the timing aspect of it. You follow me so far? Everybody follow me so far? So right here you have a list of 7 things that you would ask yourself, or that I would ask myself, if I want to trade a type 3 setup, if I'm creating a trading plan basically for a type 3 setup. Number 1, and these are just simple yes or no, yes or no, yes or no. Because they're yes or no questions, it basically creates a very black and white trading environment. Yes, no, yes, no, yes, no. Is it directional bias? Do I know my directional bias? Meaning, can I identify the closest peak formation high or low? Right? That way I know in what direction I'm expecting a trade to set up to go on. So yes, I know my directional bias because I'm coming off of peak formation high. Okay, great. So I'm looking for sells. Then did price action come from the top or bottom and get stuck in the middle of the range? Right? So it's asking me, I'm asking myself, did price action do this? Yes or no? Yes, it did. It came from the bottom and now it's getting stuck in the middle of the range. Cool. So is price action bouncing off the 50? Yes or no? Yes, it's bouncing off the 50. Okay, great. Did price action give you a pattern? Yeah, it gave me a star pattern. Great. Yes. Okay, now that it gave me a star pattern, start putting in your risk to reward ratios. Can you get a 2-to-1 out of it? Yes? Yes, I can. How about, is the TDI bouncing off the 50? Yes, it is. Is the setup happening inside of the London box? Yes, it is. So now you basically just confirmed 7 things about the setup. If you said yes to all 7, guess what? Enter the trade. You can add, if you want to, an 8 of, did you get a pullback? If the risk, did you get a pullback? Yes. No. Also, did you get a pullback if the entry or if the risk was too big? Yes. No. All right, so now you're asking about a pullback. Did you get a pullback? Yes or no? And did you get a pullback if the risk was too big? Meaning, let's say if you had a star pattern for that type 3, you know, sometimes that second part of the star pattern can be a really big ass candle, right? So it basically make the trade untradeable because of that big candle. Well, did you get a pullback after that candle? And is a pullback that you can get out of that candle, is it big enough for you to essentially get a decent risk to reward ratio at that time? Like what we talked about, you know, pulling back half the candle or whatnots. Right. So this right here is a simple yes or no, very black and white trading plan for a type 3 setup. Okay. Now, if you want to trade, let's say all of them, let's say type 1s, 2s, 3s, and 4s, right? So now, if you want to talk about trading the entire thing, now you're just talking about trading plan for everything, trading plan for all setups, right? the number one thing you got to have is still directional bias, right? Directional bias. You can even put it to where you're answering the question of not yes or no, but you can put directional bias. You can put sell or buy. Two, if we're like, say, let's selling, you're waiting for a setup to happen, right? So think about the things that you need. Because we're trading all the different types, we can't specifically have, did price action come from the top or bottom? We can't have that as a question. So now you got to start thinking to yourself, okay, what are the things that we're looking for now, right? We're looking for five, because we're looking for type 1s, 2s, 3s, 4s, right? We're looking for M or W, right? So M, did you get a M or W pattern, right? That would be another question would be timing. Is the timing correct? So we have the pattern itself, the timing, 5 candles between first and second leg. What's 5? Or the EMAs pinning to price action. So now we're basically just going through the different forms of confirmations and rules that we need for the entry, right? Is all we're looking for. So we're looking of what pattern are we getting? Are we getting a type 1, 2, or 3 pattern once we identify the directional bias? Is the timing correct? So is it happening at the right time? So either London or New York box. If we're talking about an M or W, because it's a type 1 or 2, did the second leg, are we having 5 candles between the first and second leg? And then we're asking ourselves, are the EMAs pinning the price action, right? So is that type 1 setup that's happening, is it pinning to an EMA? Right? So we've covered the pattern, the timing, the 5 candles, the EMAs, and now we're looking at TDI, right? Are we getting a confirmation on the TDI, and are we getting divergence? And then are we getting a second leg pattern? Are we getting a second leg pattern? So are we getting a second leg railroad track star pattern quarter wood? And the same thing as lastly is pullback. Is there a pullback? 9, risk to reward ratio. What is it? Is the risk to reward ratio there? So now you pretty much have a quick list of 9 things. You can word it however you want to. It doesn't matter how you word it. But as long as you understand what this is. Directional bias first. Once you know the directional bias, now you're waiting for the pattern. Based on what price action is doing, what's the pattern? Right? Do you notice that price action is basically stuck at the top of the Asian range? So it's creating a type 2. Okay, cool. So if it's creating a type 2, then we're looking for what? A second leg that produces after at least 5 candles or more after the first leg. Right? That'll be that confirmation there. Do we happen to have any EMAs that are right above that price action that's going to keep price action there to be a type 2? Look at the TDI. Are we getting the same M pattern on the TDI when it's close to the 60 line on the TDI? Are we getting divergence on the TDI at the same time? Did we get a second leg pattern finally on the type 2 pattern? Cool. What's our risk to reward ratio if we take a trade? Can we take a trade without a pullback and then execute the trade once you know what the risk to reward ratio is? So that's it. That's a really simple way to create a trading plan. And so what you can do is, if you want to create a simple trading plan, like let's say for a type 3 setup, or create a type 2 setup plan, type 1, type 4, whatever you want to do, go ahead and do it. And you'll just basically have, let's say, 4 trading plans that are like this, very short, quick, and easy, right? That you can print out on paper and have it in front of you. Print out one piece of paper and split it into 4 sections, and literally have for type 1, 2, 3, and 4. And if you want to, you can like laminate that paper, get a marker, and just mark every question as you're seeing this happening. And as long as all the conditions are met, you can take the trade. So here's the thing about this, is that this is the way that I would do it, right? Because I would want to have, if I'm taking, let's say, a type 3 setup, I would want to have an actual price action pinning to the 50, right? I would want to have a railroad track or star pattern as the pattern that I'm trading. But that's just me. I would want to have the TDI bounce off the 50, right? So this for me here would be my requirements for me to take a trade. Because I know that if all these things are aligned and they meet up together, I know that that trade is going to be a pretty good damn trade. And the likelihood of me winning that trade is extremely high. And I myself, I'm willing to wait for this to appear. Now, here's what some of you might have a problem with, is that some of you might not have the patience that I have, right? Because if I'm willing to wait for this specific pattern to show up, or for these set of rules to be met, I could be waiting 2 or 3 days, hell, a week, I don't know, right? But I'm willing to wait because I know once I do find that trade and once I take it, it's going to make up for the days that I didn't trade. But again, that's just my preference. And so this is where you have to customize it to your own preference of how many confirmations do you want to have. You may only want to have, you may not care if price is bouncing off of a 50 EMA on a type 3 setup. You may not need that requirement for the trade to be good. You see what I'm saying? So it's important. This is when you start to really think about, out of all of the setups that you've gone through the 5 weeks so far, which ones have really resonated with you as far as you finding them very easy to identify. And so once you find, if you find that type 3 setups are really easy for you to identify, okay, great. Now your job is to find out what pairs produce the most type 3 setups, or what pairs produce the most type 1 setups if that's the setup that you want to trade. There are certain pairs that produce more type 1s than other pairs. We did a study, this is one example. We did a study on type 1s. We found that if we went back 3 years on pound NZD. On pound NZD, we found within a 3-year period that it would produce about 40 to 45 type 1s. Throughout the same time frame on pound USD produced 4 times that on type 1 setups. So if you're a type 1 setup type of person and you like that setup, cool. Pound NZD may not be the pair for you to trade for that specific setup. You may want to look at pound USD instead. This is where the backtesting part comes into play, right? Because when you're backtesting, you're literally looking at and finding what setups these particular pairs do the most. And so it's very important as well that throughout this 5 weeks, you've had your hand in a lot of different pairs. Think about the pairs that you've gone through, especially when we went through weeks 1 and 2 when we talked about the market maker cycle. Think about those different pairs that you went through and you've gone through so far. What pairs have been easy for you to follow the market maker cycle? That's going to be a lot to think about, because if you found a pair that produces or that you're able to follow really good on market maker cycles, that's going to be a really good pair for you to trade, because you can follow it. You can follow the market maker cycle on that specific pair very well. So then you got to ask yourself, okay, well, if that particular pair, if I can follow that market maker cycle on that pair really well, okay, what are the patterns that this specific pair is producing the most of? And then go ahead and make a trading plan for that specific pair based on the patterns that pair produces. This is a portion, the trading plan, the backtesting, this is the portion that takes the longest amount of time. This is a part that nobody wants to do. Everybody wants to trade, but they don't want to do the backtesting or the planning. You just want to trade and win. And you expect to win, right? But you produce no planning to do it. That makes no sense. So think about this. When you're putting plans together for these setups, think about what type of trader you are. What pairs have you found super easy to follow? What pairs have you found extremely difficult to follow? There's no point in you following a pair or trying to figure out a pair that you find difficult to follow. It just doesn't make any sense for you to do that. It's a big waste of your time. So just remember, make your trading plan simple. Simple for you to understand. Don't overly complicate it. You can make it as simple as yes or no, or you can make it as rules, right? Rules like a trading plan of like, I need a directional bias, I need a pattern, I need the timing, I need the 5 candles, I need the EMAs, whatever. Right? So those are all rules. The 6 rules here need to be in place for me to take a trade. Right? And so if you start looking at your specific charts, your specific pairs, your setups, look at the setups themselves. Look at the actual setups. I mean, hell, you just made, over the past 5 weeks, you've turned in, I don't know, like freaking hundreds of examples. Look at those examples. You don't even need to go look at the charts. You've turned them in through email, right? So look at all those examples that you sent in, and look especially the ones that had the entry, especially the most recent ones where the EMAs and the TDI and stuff like that. Look at those examples. Use those. You already have all the examples. Just look at your previous 5 emails that you sent to me over the past 5 weeks of the samples that you've turned in. I've given you guys feedback on all those, so you know which ones are right, which ones are wrong. You can literally look at those examples of type 1s, 2s, and 3s, and 4s, and just look at the examples. They'll tell you what's there, what's good, and what's not. What are the common things that they all have in common? What are the different confirmations that all type 3s have in common that you would like to have? What are all the confirmations that you would like type 2s or type 1s to have? The more confirmations that you have, the better trade setup is going to be. However, that trade setup is not going to happen every day. So if you're a very impatient person and you need to have something to trade like every day, then you might not want to have 8 things to confirm a trade setup, right? At the same time, though, the less confirmations that you have, the more risk that you're going to take. And that's why, for me, I'd rather have all of my confirmations there before I take a trade, because I hate losing. I don't want to lose. Even though it happens, I don't want to lose. So I'd rather just wait. But if you're not able to wait, we understand everybody's different. But just make sure that you're okay with the fact that you might be losing a little bit more than you might like to. But I think as we get into the back testing and as you start back testing yourself, you're going to start to notice the pairs that you like, the pairs that you don't like, the setups that you're really good at versus the pairs that you suck at, or the setups that you're not really good at. And just being self-aware of that and being able to identify that is going to play a huge key for you. All right, guys. So welcome back. I hope that you got a lot out of this trading plan video, week 11. I hope it brought you some value. This week's video. I hope, man, you take and rewatch this video and take into account everything that I talked about in this particular video, because this video and the previous video are the two probably most important videos that you could watch that probably a lot of people don't watch or skip over. Okay, and then they wonder why their trading isn't getting better. So guys, do me a favor, like the video, subscribe to the channel. If you have any questions below, let me know in the comments. Also, let me know, have you been collecting data yourself? How long have you been collecting data? Do you use a trading journal, or do you actually record your trades like on video format and then rewatch your videos of yourself trading? Let me know in the comments below, guys, and we'll see you in the next one.